Hi, I'm Karina Leeson with the Kendrick Law Group Family Division, and I'm here today with Christy Nowrouzi, also known as Credit Christy. She is a mortgage broker as well as a credit specialist, and today we are going to talk to her about protecting your credit during a divorce. Obviously, I represent clients during the divorce process and other family law related matters, and this is oftentimes something that comes up, and we are so lucky and thankful to have you, Christy. How are you doing today?
Awesome, Karina. Such an honor to be here with you. I'm so excited for our time together. So thanks so much.
Great, great. So like I was saying, this is often, something that falls a little bit by the wayside, I think, with clients. They don't think about their credit during a divorce and its impact following the divorce. And so we are going to talk about some tips today that I think will be helpful to our viewers in protecting their credit. What would you say to start off is something that people should be looking to do kind of at the beginning or, as they're in the process?
Absolutely. So I'm so grateful for this opportunity because if we can get in front of this before somebody is going through the divorce process, perhaps just having this information and this knowledge can really help protect their credit. So unfortunately, as a mortgage loan officer, I see so many people on the backside of it have gone through the divorce process and their finances are just a mess. Their credit has been literally destroyed. And so if we can share some information up front to kind of try to protect that. First things first, Karina, I just want to make sure that anybody who is listening to this conversation knows that a divorce itself does not have an impact on your credit. It's not reported anywhere out there. It doesn't change anything. You have your own individual credit report, and even if you were married, you can have a merged credit report where both can report on the same report, but it doesn't merge your stuff together. It's still two individuals just kind of on one report. So when that separates, you got to make sure you're protecting your own credit. Before anything else, so much is dependent upon your credit score. Insurance quotes, credit card interest rates, if you go to get a new car loan or a new mortgage loan, everything is going to be based off, first and foremost, your credit score. So it could keep you from qualification, and it could also cost you more in a higher interest rate. And so it's that important. So first things first, I would say go and open up your very own checking account at a separate bank. A lot of times, even if it's not a joint account, that information is known by the future ex-spouse. So I would say go and start a new checking account, get your direct deposit, your money, and your bills starting to get set up that way. It's really difficult to move so much because our debit cards and all those other things are really attached to our main operating account, which is typically our checking account. So get that going first, because that's probably the hardest part of all of this is getting that moved over. And then the next thing I need for you to do is look at your credit card statements. What is getting charged? Especially while they are talking with their attorney and following the advice of their attorney and hopefully their financial advisor, starting to split up those assets on paper. As you start to do it in real life, you want to look for things that might be his or hers, subscription or monthly cost or something like that. Make sure that that starts getting paid by the other, right?
Right.
There might be some things that you can you don't need any longer because quite frankly, now that you're going to have essentially two single households, you're going to have some additional expenses in your life that maybe you didn't have when you had shared chores. So you're going to be taking on some extra debt. So where can you cut some debt? So that's where I would start first. If there is a mortgage, an auto loan, anything that might be joint accounts, there's only one of two ways to make that no longer a joint account. You either have to refinance the other person off, or it has to be paid off. So maybe you have to sell that home or you have to sell that car if you can't qualify or don't choose to do a refinance.
And that oftentimes becomes a big issue, especially when you've got real estate, there may be student loans, there may be joint credit cards. And I want to circle back to something you said at the very beginning about the credit reports. Wouldn't you recommend having people pull their credit report just to see
Absolutely.
what's on there and have an understanding? Sometimes
Yes.
that's a good beginning point as well, is to pull that credit report.
As soon as you set up that checking account, pull that credit report. Freeannualcreditreport.com. They're going to try to sell you your credit scores. You don't need to worry about your credit scores. You just want to see what's being reported on your behalf. So what's important on that is it's either your account, it's a joint account, or you're an authorized user, or you have an authorized user. So let's say myself and my spouse, we're divorcing, but I am an authorized user on his account. That means I have access and free reign to go and use that credit card, but I'm not physically responsible for that repayment. So you can see where that might get somebody in trouble. I've seen some actions of sabotage because there's hurt emotions. And so we want to kind of remove the ability to hurt somebody financially because they're hurting emotionally. So
Well,
look and see what's getting reported on the credit report.
and certainly I see that from a legal perspective. And, I would encourage clients that are doing this, certainly the timing of this, if it's before a divorce is filed or after, there could be some other restrictions and limitations with respect to the incurrence of additional debt, the use of joint assets, things of that nature. So that's oftentimes a conversation that I'm having with my clients on the legal side of it.
Yes.
Let's talk a little bit about, you know, creating a budget. I think that one of the things that's really important for folks when they're looking at their credit and they're trying to protect their credit is often being realistic about a budget. If you could speak to that a little bit.
So this is going to feel like homework. And this is, I think, why so many households don't follow a budget. It's hard. It's hard because we have so many different ways of paying, right? We have auto pay and auto drafts and Apple Pay and all of those things. So when we're dealing with that, it's hard to like categorize what goes where. So you've got your fixed stuff, you've got your housing costs, you've got your auto loans, or installment loans like student loans, those kinds of things. So those are really easy to list, and we need to be very, very realistic about the other costs involved in just living day to day. What you might find when you put it on paper is that there's a whole lot more month than there is money. And when you have more outflow than you have inflow, especially with this new environment of being a single household, a single person household, you've got additional expenses that you also have to put in there. So if you can follow a budget, you can see where there's opportunities to cut in order to make it last. Otherwise, you're going to find yourself in a position where credit card balances are increasing. I see that all the time. A lot of times they're putting costs involved, like the court costs, attorney fees, those kinds of things involved on a credit card. But here's what's going to happen. When those balances increase, it may hurt your credit score because of an overutilization of credit. And so that's a calculation of your balances to your limit, just when it comes to credit cards. But
Right.
it's so important.
That's that debt to income number that you want to keep, as low as possible.
Yes,
right.
Exactly. And so if you can create a budget, you see where your money's actually going and where there are opportunities to cut. And it doesn't have to be, I have to cut this out of my life forever. It might be, I have to cut this out of my life for right now. Because just like anything else in life changes, right? So maybe you're a year away from paying off that car, and that will free up $300, $400 a month that can go over to these kind of things, So it's really important to follow a budget. I think that's probably the number one tool in success of being able to figure out this new way of handling your finances this way is following a budget. Before closing any accounts, though, any credit cards or anything like that, if somebody is intending on getting a new mortgage, maybe a refinance or a purchase, or let's say it's a joint ownership on that car and one person's going to take it, so they're going to refinance off, before anything, talk to your financial advisor and your mortgage loan officer or your banker, whoever you're going to be doing business with, and find out if closing this is going to damage or change anything on your credit that can have a negative impact on your approval. And then once you have that information, because closing, especially long-standing credit cards, that could really negatively hurt your credit score. About 30% of your credit score is based off of your history. And most people think that history is from when you started credit. It's actually based on what is open and active right now, not that first credit card you got in college.
Right.
So once you follow their advice and guidance on what to do, what you can close, what you shouldn't close, what you need to close in order to separate those funds, then get permission from the people in your life that are guiding you to freeze your credit. So you can do that just by contacting all 3 credit reporting bureaus. That's Experian, TransUnion, and Equifax. You can put a freeze on your credit because, quite frankly, that now ex-spouse, they know your social, they know your date of birth, and they could start something in your name and have that credit card mailed to a different address, and you may not even know it unless you have some kind of credit monitoring system. So by freezing your information, nobody can access that.
And that's really a critical piece. And I think that's why it's so important to pull the credit and see what is out there in your name, so that it can be dealt with and addressed and resolved if necessary. But that's certainly a great point. Along those lines as well, the timing of that does matter on freezing the account, because if there's an opportunity for a refinance and or your credit is going to be pulled for something having to do with the divorce, what's the timing that you want to be mindful of with with freezing your credit report, freezing your credit?
Well, yeah, so most of the credit reporting bureaus will thaw it out within a couple of hours to 24 hours. So you just want to make sure that that's in alignment. Communicate that with your mortgage loan officer or the banker. When you start providing information to have your credit pulled, you'll want to say, hey, my bureaus are frozen right now. So you're going to have to be proactive in releasing that. And then you can request a temporary thaw, if you will, on those. You don't have to necessarily remove the freeze in full. You can have it, removed or lifted for 48 hours or for 1 week, something like that. So whatever your banker, lender, your person that's guiding you suggests, follow their advice on that.
That's great advice. Really appreciate that. So for my clients who are coming in and they're just getting started in the divorce process, timing wise, is it best to try and pull you in, or when should people be contacting you to get some advice about their particular credit issues?
From the very, very beginning, even though we may not act on it now, we should have a consultation, because if we have this time, right, while we're going through the process, whether it's the collaborative process or just the regular judicial process, we've got some time built in there. So there's opportunity to be able to heal some wounds if there's some things that are being reported that maybe we can correct or alter, change, end, or start. Sometimes we need to start a new account in order to remedy some damages in the past. So it's really important, especially if you're going for a mortgage loan, that we have on-time payments, right? So we're going to have those conversations. I'll remind you of how important payments are. Payment history makes up about 35% of what that algorithm is for your credit score. It's that important. So sometimes people don't realize, like, oh, if I just miss this one payment, I can get through to the month. It could be devastating for what your future goals are. So I want to make sure that your clients know some of that foundational information up front that may have just been, I didn't even think about that, or just overlooked it. Because if it's not in the forefront, it might even be so simple you just didn't even think about it, right? But we can get an idea of what your credit scores are based off of like Credit Karma. Some people have Equifax. There are literally dozens of scoring models, and so they're all different, but it'll give me an idea of where we're at, and then we can find out what we need to remedy. We can play with some really loose numbers to make sure that if your goal is to refinance the home, it may not be the right payment for where you're at right now. So if that's part of the conversation and that's your goal, but we can't make that happen on paper, let's create the best plan B that we can to put you in the right size home and the right size payment, if having to sell might be a better option than refinancing. So all of those things are really important. A lot of people don't know. Now, one of the guidelines for most loans is that if you're going to be receiving alimony or child support, you have to receive it for 6 months, and we've got to prove that you're going to be able to receive it for 3 years. And so they'll start off right out the gate going, well, I've got this money coming to me, but we actually can't use it unless it's been received for a time period. So just having those kinds of conversations. I've had a client where they were going to get a large payout, and instead we structured it as several years worth of payment so that we could use that as income. So having that conversation from the very beginning can really help fulfill those longer term goals.
Which I'm so glad that you referenced the collaborative law process, because that's something that I really am able to focus on and hone in on with my collaborative clients. What are their future goals, and plan out a roadmap, which in most cases substantially involves financials, and how they're going to provide for themselves and their children down the road. Putting that strategic plan together, working with experts like yourself, whether it's credit or mortgage lending, and some of the other trusted partners that I've had the pleasure of working with, is putting that roadmap together and helping accomplish those long-term goals. Because being short-sighted in a divorce always leads to bad results, because you didn't think about X, Y, and Z, or this contingency and that contingency. And there's so many pieces, like you said, that are intertwined. And credit is really important. So I'm so glad that we had this opportunity today to kind of talk through some of those issues.
Yeah.
One last topic I wanted to talk about, and what about the person who doesn't have any established credit? What do you recommend for that person if everything has been in one spouse's name and we've now got a spouse who doesn't have any established credit? What do you recommend in that instance?
I actually see that quite often. The fastest and the easiest path, if you have somebody in your life, a mom, an aunt, a grandma, somebody else that's coming alongside you and would be willing to help, they can put you as an authorized user on their credit card. It's not a ding to your credit because there's no inquiry. You're actually not responsible for it. So you can start getting this really long, deep, rich history without having to take on new debt. Some community banks offer a credit builder account, and so it reports as as an installment loan on your credit report. Although it's just kind of a forced savings. They're taking $50 or $100 a month out of this account over here and putting it into this savings account over here, but they're reporting it as an installment loan payment. So you can actually just create a cushion of savings for yourself without taking on new debt. I know sometimes people will be really quick to go out and open up a whole bunch of store credit cards. It's really not the best way to go. If you're looking to have a credit card, I would recommend having a bank issued credit card. So like a Capital One, Discover, Chase, something along those lines, as opposed to a store credit card. And then really work hard to maintain a balance of less than 30% of your limit to protect you from having that overutilization of that debt.
Great. Christy, thank you so much. You really provided so many helpful tips to divorcing clients and people in general who are looking to improve or work on their credit. What is the best way for people to get in touch with you if they are either looking to get information to help them with their credit, protecting their credit, or if they need to look at mortgage refinancing or obtaining a mortgage in the first place? What's the best way to get?
Awesome. Thanks, Karina. So if you want to email me, you can email me at questions@creditchristi.com. So my name is spelled KRISTI.com. I also have a podcast that's just about credit, and it's called Credit Coaching by Christy. They're short little 10-minute nuggets that could really help you have a better and deeper understanding of credit. And then I also have a YouTube channel called Credit Christy that we talk all about money mindset, budget, mortgage, credit, all sorts of different topics. So I appreciate being able to share that with you. And before we go, Karina, I've had the pleasure of knowing and being able to work with you and your clients for over 3 years now. And I hope that people have an understanding that collaborative law is a very different element than traditional divorce. And it's just such a beautiful piece for those who are going into it with the desire of having, like you were referencing, that positive outcome at the end. They're willing to talk and work it through. And I had known of your name in that realm long before I met you, because your reputation certainly precedes you. But there's just such a small amount of family law attorneys that are designated in this area. And so I love that you focus on collaborative law. It's just a very special place to be.
Thanks. I appreciate you saying that. And I know you and I both have a shared philosophy of helping our clients and bringing them information and resolution. So I really appreciate you being with us today, Christy, and thank you so much. I look forward to working with you on future cases and bringing you in as a trusted partner, not only on the credit end, but on the mortgage end as well. I know we're working on a case right now together where we had the opportunity to work together on that. So thank you.
Thank you, Karina. Thank you.
Have any questions about your credit, or you need to refinance a mortgage or establish a mortgage, please, I encourage you and invite you to contact Credit Christy. And if you have any family law issues or have a need to get more information on the collaborative law process, please contact me, Karina, at KendrickLawGroup.com. Thanks for being here today. Stay safe.